What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is April 24th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to spend some time to talk about the recent Bitcoin correction we've seen over this past week, and we need to focus in on the topic that it's time to start preparing. It's time to start preparing for the broader move to the downside. So the questions remain, is it time to finally go short right this moment? And on top of that as well, if not, what should we be expecting here over the next, say, a couple days or the next week or so before we officially build that position? We've got a lot of things to dive into in today's video, and whether or not you guys agree 100% with me when it comes to what I'm going to talk about today, I would ask that you guys, if you enjoy the video, consider dropping a like. If you learned something, it's the greatest way you guys can support the channel. And let's go ahead and kick off the rambling. Okay, I want to go ahead and start by talking about a little bit of review of what's been happening over the past week. Over the last week, we've seen Bitcoin correct from its relative high range, around the $30,500 range, down towards around $27,500. So a nice 3K correction when it comes to Bitcoin's price. And this was pretty much starting at the time when we put out our video about 10 days ago, where we talked about finally preparing to short Bitcoin. As you can see, this was one of our more popular videos as a recent, because this was the first time, even though we've been relatively bearish, I won't deny that, we've been sitting in cash for the past few months, but now we're finally starting to potentially prepare to take bets to the downside. We have been remaining extremely patient during this period of time, and while a lot of people have been on the misconception that we've been short, we've been in cash since around 24 and 25K, so really we haven't missed too much, right? So we're basically preparing now to finally make swings to the downside and trade with the broader downtrend that we've been in since the start of this bear market. Now, the key thing I want to talk about here today is some of the cues that we're going to be looking for to actually begin our short position. We have not engaged in a short just yet, and I know a lot of people might start to feel a lot more hesitant to continue maintaining their long positions, and more specifically, they may be starting to feel like they want to bet to the downside. I know many of you out there have kind of signaled that in the comments. We'll be getting more messages when it comes to people in the Dash Report discussion group. And again, this is something that I understand a lot of people are starting to feel, that perhaps this rally may not hold up, especially considering the macro conditions and the weak narratives that have driven up price. I want to go ahead and just kind of talk about that first, because the narrative we've been hearing is that this supposed new bull market, right? We think it's a relief rally here in the channel, and I'll explain why. A lot of people are claiming that this new bull market is because of a bank run, and everyone is just rushing to previous risk-on assets like Bitcoin that are now going to serve as some kind of ultimate hedge. Well, the really interesting thing is that just within a matter of 3 trading days, we went from around $30,300 down towards $27,000. That took us back to where we were basically on March 17th. So more than an entire month of gains wiped out like that. And not to mention, I'll be completely fair here, on relatively thin volume, right? There wasn't some massive sell-off. So how does Bitcoin's price go down so significantly on relatively weak volume? Well, it's the same reason Bitcoin went up so much over the past few months. The order books are incredibly thin. And this is why we've been pointing towards the dollar stablecoin liquidity index and so many other things, pointing out the fact that right now we are just not ready for that new bull market. There is not enough liquidity on the order books, and it's very easy to manipulate the spot market and benefit those whales who have the liquidity to manipulate that spot order book in order to benefit their derivatives positions. This is the key point I want you guys to keep in mind here. Now, for those of you who are curious, you might understand our narrative here, you might understand what we're focusing on, and the fact that we don't believe this rally has any serious legs. The question is, when do we actually start building our short position? Well, we've already got one of our first indicators here, right? Our key momentum indicator flipping red, signaling that the momentum is likely ready to shift down. But there's another set of criteria here that we are looking for. The second set of criteria is for a flip here on one of our key indicators, the Lux Algo indicator. You guys can get access to an over 30% discount on any of the packages for Lux Algo utilizing the discount code and the link in the description. But I want to get to the point here of why this indicator is so powerful for our trading strategy. Because this green band here, which allows us to find temporary potential short-term support, will let us know one of two things. If price gets above this band, it is likely that back here, similar to February, we're going to see some kind of move back up towards a relative resistance range, like 29K or 31K. allowing market makers and exchanges to knock out some eager shorts who are too eager to build positions and utilizing too much leverage or having too tight of stops. That just gives the exchange a perfect opportunity to steal your money, essentially, right? We don't want to be caught in that position. We want to be able to build a short position when we have a time-tested range of resistance, when we have the signs that we're actually going to be getting a flip. So there are really two setups here where we're going to start to build our short position. If we get that move, we're going to wait until we actually get a significant move. We start to see some chop at a higher range, as it's likely not going to just happen within a single day. Once we start seeing that chop, that could be our entry for a short position. But there's also another scenario. If we don't get a blast higher here above this green band, basically getting above 28K and then starting to move higher, and in fact we start to roll over towards around $27,000 and break below that band, that will be likely where we start to build a short position. It doesn't mean that we're going all in at that point or putting every dollar we have of our capital into it, but it's likely where we're going to start building those short bets. And if you guys, again, want to get access to the momentum indicator that we utilize here or our trade setups, that's where you guys get access to get those things through the Dash report. But here on the channel, I want to try to be as transparent with you guys, let you know when we're actually starting to set in those bets. But if you're looking for the fine details, if you're looking to know when we're taking profits or when we're building those short positions, you guys can follow that in the Dash report down below in the description. It's our newsletter here on the channel. But I highly recommend it if you guys haven't already, check out Lux Algo. That's going to be one of your key indicator suites here that's going to help you to stand out on top in the market. Now, before we dive further into the market, I want to go ahead and talk a little bit here about market order flow, because as we've discussed, we need to see continuous residual week by week moves of really strong positive cumulative volume delta or market order flow. And through our tool Bookmap here, one of our partners here on the channel, we are not seeing that. We are seeing negative cumulative volume delta. And we've been continuing to talk about this here on the channel because the simple fact is that over the past month or so, even though price has moved up, generally we've been seeing week by week where either we get a really decent surge in positive cumulative volume delta followed by a really red week of cumulative volume delta. In order to really sustain that long-term trend, we need to not only be seeing price maintaining strength, we need to see that market order flow is continuously in the green. And the problem here is, as we can see on Bookmap, the order books are relatively thin, right? Generally speaking, we really don't have too much activity on multi-book here, analyzing the major exchanges like Binance and Huobi, which is what multi-book taps into. This is where a lot of that deep liquidity is. And essentially speaking, it can allow for these really strong short-term variations and moves, but not enough liquidity to really sustain a long-term bull market. And I want to go ahead and dive into a whole range of other charts that I think are going to signal clearly that this is the reality that we're living in. We are not in some other bull market, but rather we are in a short-term period of relief rallies. Take a look here at the weekly chart for Ethereum. You guys might remember back during this period of time on April 14th, we were talking about how Ethereum was going to deviate above this range and that this, again, was the perfect range to start looking at getting bearish, essentially starting to plan for potential short positions, especially if we see that weakness. And take a look here, what we got. An 11 or 12% move down in a single week, completely reverting those gains and looking like we're ready to continue moving lower in the near term. Now, why is this the case here? Well, first off, on our weekly time frame, the Lux Algo resistance band coming in, giving us that perfect signal that it's time to likely get short. But on top of that as well, this was the highest range we've been in since back towards around May of 2022. This is what gets a lot of traders trapped, because a lot of people think that when you break that potential resistance or that resistance that's been holding price down for nearly a year, that's the time where everyone feels the urge to go long. If you've been sitting on the sidelines, you got cash, you're feeling the FOMO, that's the time where everyone thinks they need to strike. Everyone who didn't catch the broader rally, they get in at that point, and that is the optimal time for large-scale investors who have been riding this wave for a long period of time. That is the period of time where they offload. They use those buyers as exit liquidity to sell positions they bought at a much greater discount at a much higher valuation. That's the name of the game, guys. And if you're trading with that emotion, you will be utilized by these larger investors, these smarter people who essentially will take advantage of those emotions. And it's not that they're per se smarter at the end of the day, guys. I don't mean it as an insult. What I mean more is they know how to play the game of the market. They know how to sense and measure when FOMO comes into the market, when retail liquidity is bolstered, because the people you're up against are not always some other traders in the market. It's the exchanges. That is a cold reality that people unfortunately still don't understand to a large extent. And that is that the exchanges, at the end of the day, do not see you as a customer that they need to serve. They see you as a means to make money, especially when you start utilizing leverage, especially when you continuously set really tight stops and give them all the data they need to know on how to make you lose your money. It's just the simple reality of it. They have every data point. And to think that they're not trading against you when FTX, BitMEX, all these major exchanges and the countless others who are also derivatives product providers, they all do the exact same thing. They've been caught time and time again having insider trading desks. They've been caught continuously trading against their users, and they make much more money rather than from just trading fees having you get liquidated. Because if you can put deposits on the platform and they know 95% of the time you're going to use too much leverage and essentially lose money, why not? Why not liquidate you? And that's why, again, we don't push. Sure, we've got our partners here on the channel, guys, but we do not push referral links to leverage trading exchanges here. We do not push perpetual contracts and derivatives. It's just not what we feel comfortable promoting here. I don't want you guys to lose your money. I want you guys to focus on the long-term trends and find those solid dip buying opportunities and generally have a long bias. But we need to wait in order to get those really good discount capitulation opportunities before we really start getting serious about going long. And we've got to have the fortitude to continue a long-term bull market. I'll give a great example of this. A lot of people are feeling the FOMO on ETH. But for the past few months, we've been generally bearish on Ethereum. Why is that? Because since back in September, we've not only set in our relative high for Ethereum against Bitcoin, but since back in December when we got the red flip into January of 2023, the ETH to BTC momentum has been red on the monthly time frame. And it's been generally sideways since back in May of 2021. Nearly 2 years of sideways price action against Bitcoin. This to me is a massive distribution pattern. Essentially speaking, a period of time where people who made really solid gains, people like us who were buying Ethereum down here, getting that really solid double-digit opportunity when ETH was like $80 towards around $100. That was what we labeled as the golden opportunity in the Dash report. When we were buying down there, preparing for DeFi summer essentially into 2020 and 2021, this is the period of time where now, over a slow but steady period of time, they're going to offload into all the optimism. ETH 2.0, the Shanghai update, essentially all these things that get people really excited. Slowly distributing, selling, not too quick as to scare people and cause a panic, but just slowly offloading those prices, right? And again, one of the key things here that I think is so telling of this, that just proves that the Ethereum ecosystem, which again, probably now people are more bullish than they have been in a while, and stuff because of these network upgrades and the burn and EIP 1559 and ETH staking and how that's going to benefit the monetary policy. While everyone is blindsided by these things that are definitely optimistic for the Ethereum network, they're not asking the simple question. Is Ethereum growing at the end of the day? Is it seeing more total value locked in DeFi protocols? Are we seeing more adoption of NFTs? The things that are going to actually drive demand for Ethereum? Because at the end of the day, if we're not, it brings us back to the more important question. Are there more buyers than there are going to be sellers? Because if there isn't more buyers than sellers, price is not going to move up. That's why we talk about that market order flow. We need to know if there's FOMO or FUD. Are there more people selling than more people buying? And I got to tell you guys, the darling of the Ethereum network that I was a huge fan of, I've almost lost a ton of faith in it by now, and a lot of the narratives around it, at least it's likely not going to happen in the Ethereum ecosystem at this point, is DeFi. DeFi was, again, accelerating a rapid rate here from 2019 towards 2022. Up to 36 million ETH deposited in DeFi protocols. That now sits at right below 19 million. That is an abysmal decline. And we're not just talking about the dollar terms going down. That's already bad enough. The dollar terms for DeFi have been declining since back in November 2021 from 120 billion in total value locked to 35 billion, with a relative low of 25 billion back in January. But the problem here is that we've moved to new lows in the amount of ETH stored in these DeFi protocols. We are not seeing some mass adoption. And I'll tell you a big reason why that is. A big reason for this is because of the fact that right now, the vast majority of DeFi protocols that have gained some significant traction are going through constant hacks. There are constant breaches in smart contract code in these DeFi protocols. It pretty much disincentivizes developers, users, and the broader ecosystem from even being pioneers in innovative protocols. We still don't know sometimes when we're browsing on Google whether or not we're actually using the proper URL for a dApp like Uniswap, and we have at risk a chance where we could potentially lose all of our funds with one malicious transaction. A great example of this was the hack back about a month ago for Euler Finance. Over $200 million was stolen from the protocol. And while there is a chance that sometimes that capital can be recovered, sometimes you can get a white hat hacker who can get back 30, 50, 75, sometimes 100% of the funds. In the vast majority of cases, that money will never be seen again. People's hard-earned money. And this is why, again, I come back to this point here, guys, whether it's leverage trading, whether it's chasing the hype on some kind of altcoin, you are much more likely to lose a significant amount of money versus making money if you're chasing these opportunities in a bear market where there are opportunists out there. Don't think that there aren't people, whether it be large entities in the crypto space or hackers, who essentially want to take your money. And this is why, again, I want you guys to be prepared. One of the great tools you guys can utilize to protect yourself in this environment, to make sure that when you are engaging in DeFi, whether you're making swaps on Uniswap, depositing to get yield in a protocol like Compound, that you're utilizing the right protocol and making sure that you are not susceptible to these kind of attackers. And that's why I want to spend some time to talk about one of our long-term partners here on the channel, and that is WalletGuard. They're a new partner of ours that we're going to be talking about from time to time. And essentially, WalletGuard is focused on being your effective aid when utilizing DeFi protocols and utilizing your browser extension wallet. For those of you who use MetaMask, the Brave browser wallet extension, or even different types of wallets for other ecosystems like Solana, such as Phantom, the WalletGuard application is a free-to-use browser extension that can help you navigate the DeFi environment, whether you're utilizing DeFi apps or trading NFTs and other types of DeFi-related transactions, in order to help you protect your money. They have protective URL scanning that will allow you to see whether or not a link is malicious or the official URL of a decentralized application, so you can know that you're on the proper website when conducting transactions. But on top of that as well, there's also transaction simulations. So you can see, instead of a bunch of hexadecimal code, you can see real-time information about what you're doing with your funds, whether or not you're actually engaging in a swap, or if there's a malicious transaction that's essentially trying to steal your assets where you'll get nothing in return. This is the kind of stuff that can really help to simplify the broader crypto experience, and it's free. It's one of the best ways you guys can help to navigate the DeFi environment safely and make sure that you guys are well protected. I've already got the browser extension installed here as I utilize a couple different browser extension wallets. And if you guys are interested, check out the link down below in the description. There's already over 10,000 users utilizing the application. And as I mentioned, it's free to use. Why not have it on there to help secure your experience? I've had one or two experiences where I've almost engaged in malicious transactions in the crypto space. And if I didn't have the experience that I had behind me and I was just getting started in this space, I probably would have fallen for those transactions and lost a lot of money. It's something that you can't afford to lose on, guys, and it's definitely something I recommend that you guys get set up here when it comes to utilizing the application. So I want to go ahead and talk a little bit here about finally what's going on in total market cap. We've talked about this as well for a period of time. We wrote back in late March, early April here on the channel that essentially we've come up into this band here, this previous range of support during the last bull market, which is now serving as resistance. We've hit that red band here for the Lux algo on the weekly time frame, and this is where I think we're going to start to really see total cryptocurrency market cap from this $1.1 trillion level come down into some of these pockets of value where we think there could be some good opportunities for accumulation. What are some of these ranges we're looking for? Well, we're looking to essentially build positions around this $800 billion range. We're looking to dollar cost average even heavier here, around $550 billion. And when we come in towards this potential bottom range or accumulation channel that takes into account a lot of the resistance points from 2020, 2019, and 2018. If we get this opportunity, this is where we are going to go very heavy into the market. But it's also not the range I would tell you guys to just wait on. I think it's about averaging in, and if we can get a general entry where the vast majority of our weight is at a valuation between 550 or 350. This is where a lot of that opportunity is going to pay off, where essentially we're going to get in at a really good discount. We don't have to stress about it. We don't have to chase every relief rally. And essentially we're going to have a solid discount purchase opportunity sometime here in late 2023. And I think that the macro environment is starting to signal this. We are continuing to see signs of weakness across all the indices. The Dow Jones has continued to set in relatively lower highs since back in December of 2022, signaling that even the defensive stocks are not where you want to rush to here. If we are in a new bull market, especially these defensive stocks should be able to lead the way forward and get to new all-time highs considering their dividend profile, their cash flow. And right now we are not seeing that, right? We're seeing consistent chop. We've been seeing that for a while here on the weekly trend here, essentially to a point where I'm not utilizing my momentum indicator here. It's shown no reliance here on the weekly time frame when it comes to the Dow Jones. It's too choppy. There's no clear trend. And that's not an insult to the momentum indicator. It's just the circumstances. If I don't see that something moves in consistent up and down trends over a multi-month or multi-year time frame, I'm not trying to trade that market. The indicator is signaling to me that we're in an environment of chop that is uncertain about the future. Now, if we take a look at the monthly time frames though, especially on the index here like the S&P 500, which is a broad representation of the stock market, while we have moved up over the past couple months, it's been mainly really that we've been chopping here since back in May. And the momentum indicator flipped red going into this period of time, signaling that right now, even though we've had some optimism, markets are not blasting to new all-time highs. And once more, we may not really have the sustained momentum to actually move higher in the long term. I want to go ahead and just kind of close things off here, guys. I think it's very understandable. It's very understandable, guys. I've been there before, and over my nearly 12 years of trading in financial markets, started back in 2011. During this period of time, I made a ton of mistakes. And a lot of them stem from feeling that emotion that I think so many of you can relate to. It's not something that I'm berating you guys about. I know many of you out there have been patient, have been waiting to build those positions. And if you have, that's really wonderful. If you guys, on the other hand, did buy into positions at these heightened ranges around, 27,000 to 31K, it's not a bad thing to sometimes take a small, medium-sized loss and really start to counter and actually trade against those emotions, right? And I'm not telling you guys you have to do anything. If those are long-term positions and you're fine assessing the risk with it, that's totally fine, right? I'm not here to dictate what you guys have to do, and I'm not here to speak in absolute terms. The point I want to make, though, is that at the end of the day, we need to be able to counter the crowd. We need to be contrarians in this environment. And we cannot ignore the reality that in the macro environment right now, there is still a lot of inflation in the economy, and that the Federal Reserve is going to have to continue tightening much higher than people expect. We have been on that narrative for the past year and a half, whereas a lot of other people have been just constantly bullish, and it is proven right time and time again that inflation is sticky, it takes time to correct, and to think that Bitcoin and other risk-on assets like altcoins are not going to struggle in this environment where monetary policy is in a tightening fashion rather than loosening, well, I think a lot of people are going to have a big thing coming to them over the next coming months, guys. This is why we've been mainly in cash, and if anything, we are shorting overt optimism in the market. I do not see any sustained rally or potential narrative that's going to drive valuations higher in the long term. The only narrative that is being shared around is AI, and as you guys know, markets have certainly priced that in. They have certainly, to the most optimistic extent, propped up names like Nvidia, which are still having massive inventory issues. They have propped up valuations in companies like Microsoft, which are still already overweight in their representation of the overall valuation of the stock market to a large extent. These names are way too highly priced. And we have to ask whether or not they can continue to rally, because if they can't, who's going to? Who's going to be the market leaders? So I've rambled on a good amount, guys. Again, at the end of the day, you come here for my opinion. I hope you guys enjoy that opinion, and whether or not you agree or disagree, if you could drop a like, it's one of the best ways to support the channel. And if you guys are interested in checking out any of our partner tools, whether it be Lux Algo, Bookmap, or checking out the newsletter, we've got all those links down below in the description, as well as the link towards the Chrome extension for WalletGuard. But that's going to be it for today's video, guys. Thank you all so much for giving me some time to ramble, as always. And until the next video, I'll see you all in the next one. Take care, everyone.